Let's talk about Warren Buffett. For decades, the guy has been this investing legend, right? But the question that always comes up is, how? How did one man, working out of a quiet office in Omaha, Nebraska of all places, build this multi-billion-dollar empire? Let's dive in.
I mean, this is the billion-dollar question, isn't it? For years, people have been trying to crack his code, hunting for some kind of secret formula or a hot stock tip. But here's the thing. Buffett's success, it doesn't come from some complex algorithm. It comes from looking at the entire game of investing in a totally different way.
And this slide, this gets right to the heart of it. You see, Wall Street is playing one game, short-term speculation. They're chasing prices, they're following the herd. Buffett is playing an entirely different game. For him, it's not about buying stocks, it's about buying businesses. He couldn't care less about the daily blips on the screen, he's obsessed with how the actual business is performing. It's a total mind shift.
So, what is this big secret? Well, the foundation of his whole philosophy is to think like you own the entire company, not like you're just trading a stock.
You know, you'd think the hardest part of Buffett's strategy would be all the number crunching, but it's not. The hardest part is unlearning everything Wall Street tries to teach you. It's about tuning out all that market noise and just focusing on one simple question. Is this a piece of a wonderful business that I want to own?
Let's make this super simple. Imagine you were actually buying the little drugstore on the corner of your street. You wouldn't be refreshing its stock price every 5 minutes, right? Of course not. You'd ask for the books. You'd want to see if it's profitable, if those profits are steady, and you'd figure out what kind of return you'd get for your money. That's exactly how Buffett looks at a company, whether he's buying one share or the whole darn thing.
Okay, so if you're thinking like a business owner, the next obvious question is, what kind of business is actually worth owning? In Buffett's world, there are basically two kinds of businesses. On one side, you have the mediocre ones, the commodity types. Think steel mills, textile factories, gas stations. In that world, price is the only thing that matters, which means you get brutal, cutthroat competition and teeny tiny profit margins. But on the other side, you have the excellent businesses, the ones he calls a consumer monopoly. So what on earth is a consumer monopoly? Well, think of it this way. Imagine you own the only toll bridge in town. If anyone wants to get to the other side of the river, they have to drive over your bridge and they have to pay your price. That's a consumer monopoly. It's a business that's so powerful and so protected that it can basically name its price. And here are some classic examples. Just think about it for a second. Your local convenience store has to stock Coca-Cola. If they don't, people will go somewhere else. A pharmacy has to carry Gillette blades. These aren't just strong brands. They're so dominant that retailers risk losing business if they don't have them on the shelf. That right there is incredible power. And a huge clue that you've found one of these amazing businesses, just look at their earnings history. Look at the difference here. Company I is all over the map. One year it's up, the next it's way down. Who knows? It's impossible to predict. But Company I, that's a different story. It's a beautiful, steady, upward climb. That's the kind of business you can actually understand and value with some confidence.
All right, so you found a wonderful business. Fantastic. But that's only half the equation. Now comes the second, crucial part. What's the right price to pay for it?
This is one of the most important rules in the entire Buffett playbook. The price you pay for something directly, mathematically, determines your return. This is why Buffett's excitement for a stock actually goes down as the price goes up, which is the total opposite of how Wall Street thinks. A higher price simply means a lower future return. It is that simple. And the math here is just shockingly simple. Let's say a business earns $5 a share. Well, if you pay $50 for that share, you're getting a 10% return. Not bad. But if you're patient and you wait until you can buy that exact same share for just $10, your return explodes to 50%. Same great business, totally different outcome, all because of the price you paid.
Okay, now we get to what many people call Buffett's greatest secret. This is the real engine behind his success. This is the absolute magic of compounding. So here's the key difference. Most investors think about returns as dividends. The company pays you some cash, which is nice, but then you immediately have to pay income tax on it. Buffett,
He prefers it when companies keep their profits. He literally sees those retained earnings as his own money being reinvested for him by the company's managers, where it can grow and compound year after year, completely shielded from taxes. And the result of letting that money grow tax-free inside the business is just spectacular. I mean, look at this. An investment that's taxed every year might turn 10 grand into 32 grand over 20 years. But one that gets to compound tax deferred inside a great company, it can turn that same 10 grand into over $160,000. It's not even close. That gap is the secret fuel in Buffett's wealth engine.
And nothing shows this compounding mindset better than this story. When Warren Buffett looks at, say, a $20,000 car, he doesn't just see 20 grand. No, he sees the nearly $10 million that money could turn into if he just left it alone to compound in one of his businesses for a few decades. That's how deeply this idea runs in his mind.
So how do we pull all of this together? How do we make it practical? Well, it all comes down to a really simple but powerful mental exercise.
Just imagine this for a second. Imagine you got a punch card when you were born and it only had 10 holes in it. 10 investments for your entire life. That's it. Would you be jumping in and out of hot stocks based on some rumor? No way. You would do incredible amounts of research, you would wait patiently for the absolute perfect pitch, and you would only swing with the highest possible conviction. And that, right there, is the heart of Buffettology. It's not a get-rich-quick scheme. It's more of a get-rich-for-sure philosophy, and it's built on these 4 pillars. First, you think like you own the place. Second, you only buy truly excellent businesses, those consumer monopolies. Third, you are ruthlessly disciplined about the price you pay. And fourth, you just get out of the way and let the magic of compounding do its work for decades.
So, I'll leave you with the one question that this whole philosophy really boils down to. Thinking about this can completely change how you approach building wealth. If you only had 10 punches on that lifetime investment card, what would you do differently? What would you own? And just how much more successful do you think you'd be?